Well, that right there was the right kind of downside surprise. Live from New York City this morning. Good morning, good morning. For our audience worldwide, when was the last time you saw some price action like this? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, inflation in America.
The CPI number.
CPI.
Happy CPI day. The underlying elements of this report are actually, they're good.
CPI is the number one thing the Fed is focused on.
It's been a recurring nightmare for investors.
The Fed is really laser focused on the inflation readings.
There is no Fed member that wants to go down in history as losing the fight on inflation.
It's going to tell us whether that December meeting is 75 or 50.
It does support, I think, what is the Fed's leaning towards wanting to downshift in December. Inflation has been very, very slow to come down.
Boy, the descent is going to be gradual.
There's, some evidence that we are moving from peak inflation down lower.
The near-term risk is about Fed. It's about inflation.
We're getting some deceleration, and this equity market is absolutely exploding. Joining us now to discuss, Jim Bianco of Bianco Research, Krishna Mamani of Lafayette College. Jim Bianco, the floor is yours, sir. What do you make of this one?
Well, on one respect, it shouldn't come as a surprise that inflation has peaked. I think everybody understood that. And I think the bigger discussion that we need to have is how far down is it going to go? Is it going to bottom out at 2% or something above that? I'm in the persistent camp. It's going to bottom out something before that. But as far as today's action goes, Jonathan, we're only a couple of weeks away from the one-year anniversary of when Chairman Powell said we need to retire the word transitory. We've never retired the word transitory. Most of Wall Street still believes that this inflation is transitory, or the Fed's got to pause, or they got to pivot, or they got to step down, or whatever variation we want to use on that. And this is only the third time in the last 20 months that the inflation number has come in below expectations. And this is what everybody's been hoping for. So you can see the jubilation and the incredible move in the markets right now. But after we look at today, we're going to have to ask the question, do we go all the way back to 2%, or do we go back to 3.5% or 4%? Because we go back to 3.5% or 4% and stop there, then the Fed's not done.
Let's go through this with purpose. Jim Bianco, we've got a 20 basis point move at the front end of the curve at 437. In the equity market, the S&P 500's up by more than 3%. The NASDAQ is like +4 right now. Jim, have you ever seen a move like this off the back of a single data point in America?
I don't think I can recall ever seeing from one trade to the next a 2.5% up move in the stock market on the futures contract like that. I've never really seen it. And it just goes to how focused and how important this data is. This is the most important event of the month right now for all financial markets, is the release of the CPI report.
Krishna, I know you're itching to jump in. It's all yours.
Well, so I take the other side of what Jim was just saying. I don't think, based on what Jay Powell was saying in his presser, one could conclude that in the judgment of the FOMC, which is what matters more than anything else, that inflation had peaked. That's why we had price terminal rate meaningfully higher out of the press conference. So I think there are people who were hoping for this, but I don't think that's what the FOMC was hoping for. And therefore, it is a total surprise. And it is definitely a welcome surprise from their perspective. The real question is, will this persist? I think this month, a whole bunch of things came together. And to Jim's point, it is quite probable that we probably don't see this trend continue, and we may actually see a bit of a reversal.
Well, Krishna, you're both asking the same question, aren't you? And the same question is, basically, where do we bottom out? A few months down the road, a few quarters down the road, Krishna, where are you thinking we bottom out? Do we get stuck at 3, 4? Is that the conversation, the thought, the debate that you're having?
Yeah, so I think the bottoming off will probably be more like the first quarter of next year rather than the fourth quarter of this year. Again, as I said, a whole bunch of things came together. This is a good number. It indicates where we are headed. However, looking at it and running with it in full form, I don't think is really the right thing to do.
Jim Bianco, your reaction?
Yeah, no, I think that it really is a question about, where we are going to bottom, and that is going to really drive the Fed. And that's going to drive really the debate now. The debate is I know everybody focuses the debate on December and whether or not we're going to move 50 or 75 in December. It now looks like 50, and the market's overwhelmingly pricing that in. But where is the terminal rate going to be? I still think if we have a sticky, persistent inflation problem, the terminal rate is still going to be around 5%. Maybe it's not going to be 5.25. It might be 4.75 to 5 as opposed to 5 to 5.25. But it's not going to go down to 4 or 3. And we're not going to, get the Fed to have some kind of a major change unless we see a lot of collaboration in this data. And that means weaker payrolls, weaker earnings, weaker GDP to fit with a narrative that the economy has seriously decelerated. We don't have that. Lost in today's debate right now is that the initial claims number was actually okay at 225,000. So that's still historically a very low number. And so we're not seeing any evidence from that there's a problem in the labor market.
Jim, I want to pick up on something you just said and compare it to something you said a little bit earlier. We're doing more than just pricing in 75 to 50, aren't we, with a move of 3% in the equity market and a move of 20 basis points lower right the way through the curve. That's more than just pricing out 75, isn't it? We're pricing something else in for next year, it feels like.
Yeah, I agree. I think, go back to my original comment. The vast majority of people still think inflation is transitory. They still think the Fed is overdoing it. They still don't understand why Jay Powell is being so hawkish and becoming Volcker 2.0. And they're looking at this data and saying, this is it. The Fed's going to stop. And maybe next year they're going to start cutting rates. We're going to turn the printing presses back on. And we're going to go back to 2019. And it's all going to be okay. That's really what the hope is in this market. And today's number fed right into that.
Big move in the equity market on the S&P up 3%. Yields lower on a 2-year by 21 basis points. Yields lower right the way through the curve. On a 10-year, we're down about 17 or 18 basis points. So yields down, equities up. Guess what the dollar's doing? It's a whole lot weaker. Euro dollar reclaims 101.18. That currency pair with a 1% move higher. Mike McKee, you've had about 36 minutes to go through this one. What do you make of it?
Well, in general, it's good news. You look at the headline numbers and we see that they came in better than expected in every category. The numbers that really matter to the Fed are the monthly changes. And there we saw the headline numbers drop to 0.4 for the headline, and the core drops to a 0.3 move. And it does start to show maybe the beginning of a sequential decline. Now, what moved is also important. Gasoline was up by 0.4 after dropping by 0.5% last month, by dropping 5% last month, and that was to be expected. But food at home drops, owner's equivalent rent is lower, used cars are lower, apparel is lower. Goods prices in general are falling, and that's what really drove the number down. Now, the bad news side is that services prices are still rising at an increasing pace. So that's what's going to have to turn around for the Fed to get where it wants to go. We do have a lot of Fed speak today. We'll get some interesting reactions to that. We can see here the pricing for the December Fed meeting. It's dropped to basically almost a 1/4 point, not just a 1/2 point, but below a 1/2 point. We'll see where it goes from there. The terminal rate that Jim Bianco was talking about is at 4.88 in May. So that hasn't dropped a lot from 5%. That would imply a 5% rate. The first Fed official to speak after the number came out is Patrick Harker from Philadelphia. Now, he's saying that he thinks PCE inflation, which runs lower than CPI, is going to be at 3.5 by the end of next year, which would be appreciable progress. And he says this: in light of the cumulative tightening we have achieved, I suspect we will slow the pace of our rate hikes as we approach a sufficiently restrictive stance. But I want to be clear, a rate hike of 50 basis points will still be significant. And he goes on to say, we also need to recognize this will take time. Inflation is known to shoot up like a rocket and then come down like a feather.
Mike McKee, thank you, sir. That's quite a quote. That's Harker behind us. Then you've got Logan, Daly, Mester, George all lined up to respond to this and I guess respond to what's happening with Fed policy into next year as well. Krishna, we need to talk about consequences. We've had 400 basis points of tightening basically in 8 months. That's a lot of tightening in a very short amount of time. Now we need to talk about consequences. Is the price we're going to pay for that a 25% move on the S&P 500? Was that it? Or are you looking for more?
Well, so again, as I said, whether this trend persists or not is really going to be the driver for this. But I think going back to a point that Jim was making, the difference, or at least the impact, is really not whether we moved much on the terminal rate today. I think the impact really is we are pricing out the likelihood of terminal rate at 6, 7, 8%. We are basically capping the terminal rate. If that's the case, I think there's a good case to be made that we have probably seen the bottom of the equity market. Again, for that to be the case, the trend in inflation has to persist. That remains to be seen.
Jim, your thoughts?
Yeah, I mean, the terminal rate probably is getting capped out at around 5% right now. And there's been talk earlier this week that it might be going somewhere higher, like to 6 or 7, as Chris just said. But I do think that we need to, and I'm going to agree with you, we need to see some kind of a massive deceleration in the market, in inflation, in order to say that the equity market is bottom. Now, we've got one good number, as I mentioned before. It's only the third time in 20 months that we've gotten a good number. Let's see if it gets followed through in the data over the next 2 or 3 months, whether or not that it supports this idea that the Fed can just raise rates 50 basis points a couple of more times, and then they can pause for the rest of 2023.
Well, here's the runway for the rest of 2022. December 2nd payrolls, December 13th CPI, the Federal Reserve meeting December 14th. For those of you interested in the politics, I believe the Georgia runoffs are slated in for December 6th. Jim Bianco, there'll be a lot of people writing stories today about so-called soft landings. What would you say back to them?
It's too early to say whether or not we've had a soft landing. What we've had is we've had one good number on inflation, and we have yet to see a turn in the data, especially in the labor data, and I'm thinking about the payrolls report, to suggest that we've actually started a soft landing just yet. So it's still very much an open question as to whether or not we're actually going to get one.
Krishna, final word on that.
I think the likelihood of soft landing has gone up meaningfully. If you get this sort of inflation data, while the growth outlook is actually remaining relatively strong, that's what you need for a soft landing to come about. So the probability is meaningfully higher. I disagree with Jim on that count.
Krishna Mamani, Jim Bianco, sticking with us. Equities right now up by more than 3 percentage points. Coming up on this program, more good news for President Biden.
While the press and the pundits are predicting a giant red wave, it didn't happen.
That conversation up next.
While the press and the pundits are predicting a giant red wave, it didn't happen. And I know you were somewhat miffed by my obsessive optimism, but I felt good during the whole process.
And that was a little bit of a victory lap for the president yesterday. Good news for the Biden administration. The latest inflation data showing slower pace of price increases and Democrats delivering better than expected midterm results, with the Senate still up for grabs. Joining us down in D.C. is Bloomberg's Anne-Marie. Morning, Anne-Marie.
Good morning, John. Really a sigh of relief, I imagine, for the White House. Of course, inflation north of 7% is still way too high for any politician, but it's the lowest it's been since January. So the Biden administration, we're waiting for what they have to say on this inflation report, but clearly this is a sign that things are moving in the right direction. And yesterday, when the president came out to talk about the midterm election results and really just, really wanted to rub it into the press in the room, saying that maybe we were miffed and didn't believe his optimism. The fact of the matter is he brought up inflation. He said he can't guarantee that they're going to be able to get rid of it, but he did say things were moving in the right direction, and he pointed to the likes of gasoline going down. He's going to the G20 in a very, very different mood. AMH, you're going to cover that for us, and I think we're going to catch up with you a little bit later this hour as well. Looking forward to it. AMH down in DC. Julian Emanuel of Evercore wrote a fantastic note yesterday evening. I picked out a quote, but we're going to talk about something else he talked about. Here's the quote for him. The uncorrelated outcomes of elections across the US reinforce the idea that, much like stocks in 22, voters prefer governance and local issue alpha over political party big picture beta. He went on to say election integrity rhetoric likely moderates a win for everyone. That was Julian Emanuel of Evercore. He also talked about crypto and contagion. And I want to have that conversation right now with Jim Bianco and Krishna Mamani. Jim, walk us through what you're seeing in an asset class that you've followed more than most, and the prospect for contagion from your perspective.
I think the prospect is very high for contagion. FTX is an offshore exchange. It's the second largest in the world. There are hundreds of thousands of accounts on that exchange. That includes institutional accounts. That includes the treasuries of crypto protocols. That includes hedge funds. That includes other brokers. That includes institutional investors, miners, validators. Their money is trapped on that exchange. They need to be able to access their money because they've got obligations they have to meet. They've got counterparties they have to satisfy. If that exchange does not reopen and allow them to have withdrawals, then they're going to fail to their counterparties. Their counterparties are going to fail to their counterparties. Crypto protocols, especially those that were tied up with FTX Ventures, that raised money, have their money in FTX accounts, they can't access it anymore. They can't pay payroll. They can't do anything with it. So if this exchange cannot reopen, it's the impact, the knock-on effects are going to reverberate all throughout the entire crypto space. And it might even start to leak into the traditional financial space, especially the tech space. We've already seen that Sequoia has written their $100+ million investment down to zero. There'll be other things along those lines as we move forward if this exchange cannot reopen.
Jim, can you help us understand the numbers here and the depth of institutional adoption that you think is of concern when it comes to contagion through traditional asset classes like the ones you just talked about?
You know, in total, it is estimated that there's about $40 billion of institutional money that has come into crypto protocols in the last 10 years. 25 of that came in last year. That's money that's investing directly in these protocols, not buying coins. That's a different story. A lot of that money has been lost. A lot of that money was in the Terra Luna blockchain. It was in FTX. It was in Celsius. It was in Voyager. It was in BlockFi. These are all exchanges and protocols that have failed this year. So a lot of that money has not just had a bad year, it's gone to zero, is what's happened. And so this is going to probably cause a review and a rethink as to how one should be investing in this space as we go forward.
Krishna, how are you thinking about this situation?
Well, so I think Jim makes a good point. That is, FTX failure certainly will have a contagion effect. I wonder if the magnitude would be of the level that he's talking about. That is, the institutional investors, especially VC investing in the space, really has been very, very aggressive. So certainly there is going to be a meaningful markdown of those types of valuations. But I don't think this is really saying, or it would be appropriate to say that all of that is basically going down to zero. I think there are lots of protocols, lots of work that will probably persist even after we go into a relatively cold winter for crypto per se. I think this definitely puts takes the oxygen out of the atmosphere, but it doesn't really get it down to zero, or we are not in a vacuum any longer.
Well, Jim, how cold do you think that winter's going to be? And I guess the question I'm asking is, how deep do you think the scars will be for this asset class, given what it's gone through over the last 12 months?
Oh, I think that the scars are going to be deep because what they've been relying on, in the phrase we like to use there, is building. We need to build new protocols. We need to build new opportunities. And in order to do that, you need money from VCs. You need money from outside investors to come into the protocols. That's what would drive the idea that cryptocurrency coins would go up. Well, that's what's really been hurt a lot. as we've seen this year. And so if you're looking to raise money because you've got a better idea on a crypto protocol, it got a whole lot harder in the last 3 or 4 days than it has been. And a lot of people that might even give you money have gotten so many losses that they might not even have the capacity to give you money anymore. So no, will crypto get through this? Yes, crypto will get through this. But this is going to be a very tough slog. And crypto's seen this before in 2016 and 2019. It can get very, very dark before the skies break and things get better.
Well, it's certainly dark now and it's getting darker. Jim, great to catch up with you, sir. Jim Bianco, Christian Mamani, to the both of you. What a move we're seeing in this market, away from Bitcoin at the moment, which is trading at about 17K right now, down from pushing 60, 70, 12 months ago. The S&P 500 is absolutely ripping, up by more than 3%. In the bond market, yields lower by about 19 basis points. And the dollar in this FX market is a whole lot weaker, with some breaking news just moments ago. Here's Abby.
Indeed, John, and related to everything that you all were talking about in the terms of the possibility of crypto contagion and that liquidity crunch, the dark web. We just had breaking headlines around the FTX CEO tweeting that Alameda Research is winding down trading. They aren't doing any of the weird things that I see on Twitter, and nothing large at all. And one way or another, soon they won't be trading on FTX anymore. This, of course, is FTX CEO Sam Bankman-Fried, also owner of Alameda, an embattled crypto proprietary trading and venture capital firm. It's gone dark. There have been several reports this morning about the fact that it's going dark and that they're no longer trading crypto. But here we do have confirmation of that from the FTX CEO, Sam Bankman-Fried. So this story continues to go on. It's going to be interesting, John, of course, to see how far and wide it continues to go.
Abby, thank you. Got some coverage coming up a little bit later for you. Shanali Basak, a Wall Street correspondent, is going to break things down for you piece by piece. Peter Chi of Academy is going to weigh on this potential for contagion as well, from crypto through traditional asset classes. Right now, we're absolutely ripping. If you're just tuning in, big downside surprise on inflation in America, and this market explodes higher. On the S&P 500, up by 3.6%. Coming up, the morning calls, and later on a rip-roaring rally, we'll catch up with Victoria Fernandez at Crossmark in about 7 minutes' time. This is Bloomberg. 8:30 Eastern Time, CPI comes out and you just get a massive green light to buy. On the Nasdaq right now, up by 4.7%. On the S&P, up by 3.63 percentage points. Unreal move. That's the price action. Let's get you some morning calls. First up, UBS downgrading Altria to sell, saying investors remain overly optimistic about the company's outlook as consumers start opting for cheaper products. Next up, Loop Capital upgrading Palo Alto to buy ahead of earnings, expecting the company's strengthening enterprise business to drive next week's results. That stock up by 7.5%. And finally, Wedbush removing Tesla from its best ideas list. Dan Ives expecting Elon's Twitter tobacco to weigh on shares at least until new deliveries hit in January. That stock, though, this morning is flying. This whole market's flying. Up next, stocks roaring higher on that CPI print. Crossmark's Victoria Fernandez saying to sell the rips and buy the dips. That conversation up next. Your opening bout just around the corner. What a move. Let's not rush this. 20 seconds away from the opening bell. When was the last time you saw a market like this? Intraday. On the S&P 500, futures up by 3.7%. On the Nasdaq 100, post CPI from an hour ago. On the Nasdaq right now, up by 4.9%. It's your opening bell. Switch on the board and take a look at the bond market. The move's just as large. Yields down by 18 basis points on a 10-year, 391.56. On a 2-year, down 20 to 437. Last Friday, after the payrolls report, we had yields very close to 480 on a 2-year. Now all the way back down to 437 and down 21 basis points on a session. Once I've told you that, you can guess where the FX market is trading. The dollar is trading a whole lot weaker. Euro dollar 101.47. That currency pair up by 1.3%. And crude not doing a whole lot. 85.60 on WTI. We're negative by 0.2%. This equity market absolutely ripping. 30 seconds into the session on the S&P 500 up by 3.6%. On the Nasdaq up 5%. A big boost to big tech post CPI Here's Katie Lyons.
Yeah, John, big tech loves this cooler inflation, probably because it is sending yields dramatically lower on the intraday basis. The 10-year yield is down something like 18 basis points today. And those lower borrowing costs do help hire multiple companies, the likes of Apple, Amazon, Tesla, Nvidia, all getting massive, massive lifts at the opening bell here in New York. Apple up 5%, Amazon and Nvidia up 8 and 7% respectively. And Tesla is getting a lift to the tune of about 7% as well. The thing about it, John, though, is this is just one single day. And yes, we may have yields dramatically lower on the day, but still we're up 240 basis points on a year-to-date basis on the 10-year. So longer term borrowing costs are still a lot higher than they were a year ago, which is why we have seen the valuations for these companies come in so dramatically this year. And what that means is all these heavyweights are less weights than they were in this equity market. In terms of the S&P 500 and the NASDAQ 100, the NASDAQ 100 index share of S&P market cap has been steadily declining. And of course, that isn't just because of a big macro narrative. Their fundamentals have suffered too. Their earnings getting hit by inflationary pressures and the waning demand that has resulted from that. So because of that, the tech sector was the fourth worst performing among major S&P sectors in the third quarter in terms of earnings growth. Actually, earnings were down about 3.3% on a year-on-year basis. And then in communication services, which of course houses Alphabet, aka Google, and Meta, aka Facebook, that was even worse. Profits in that sector down 21% in the third quarter. So it has been a brutal road for tech, John. They're just getting some relief after that cooler CPI this morning.
Just massive moves, Kaylee, and great work as always. Let's go through it together. If you're just tuning in, where have you been in the last hour? CPI 60 minutes ago. The estimates for headline year-over-year inflation were anywhere from 8.1% at SocGen and others to 7.8% at Goldman and others. Year-over-year headline came in at 7.7%. This market, Wall Street, very focused on the potential for deceleration in core month over month. That's exactly what we got. Downside surprise there too. So equities roar, ripping, explode off the back of that. On the S&P right now, we're higher by about 3.5%. If you close the market right now, that would be the biggest one-day gain going all the way back to April 2020. Major moves in equities, big moves in the bond market too, down by 21 basis points on a 2-year, 437. Katie talked about the rest of the year. I'll go through the dates. For the politics, the Georgia runoffs, they're slated for December 6th. For the market, December 2nd on the payrolls report, December 13th for the CPI report, December 14th for the Federal Reserve. That's when you get the projections for 23 and beyond. And we're going to have a much bigger conversation about how far this Fed needs to go. Avoiding recession hinges on how far is far enough for inflation to fall. That's the view from Crossmark's Victoria Fernandez writing this. The problem lies in whether the Fed will be satisfied with 4 to 5% inflation and take that deeply desired pause. If not, and 2% continues to be the goal, then we will continue with more rate hikes and will likely push the economy into recession in 23. Victoria joins us right now. Victoria, I'm going to go back to that quote in just a moment. Let's just start with your reaction to that data an hour ago.
Yeah, I mean, Jonathan, I'm really kind of shocked that we're seeing such a huge response. I mean, especially when you look at the NASDAQ, you and Kaylee were just speaking about that. The fundamentals in those companies really haven't changed. Yes, when they do their discounted cash flows, that's going to be a little bit different. They're long duration stocks, so I can see them rallying a little bit. But 5% when we still have demand that's been pulled forward, you still have restrictions in regards to chips being exported, all of that. I'm really kind of surprised we have seen such a strong rally. We did expect inflation to come down a little bit. And as you mentioned, month over month is key. That's what the Fed's looking at. And you look month over month, a big component of that was used car prices and apparel. We expected that as well because supply chains were doing better. So I'm glad that we've seen the month over month numbers come down. I'm surprised that we're seeing such a positive move in the markets. I would expect we're going to give some of this back, if not tomorrow, probably beginning of next week.
Well, Victoria, let's break it down then. As always with data, you can learn something from the data and you can learn something from how the market responds to it. What do you take away from how the market's responding to it this morning?
Well, I think we're getting a little bit over our skis, and we've done that before. This is what our third, what I consider a bear market rally so far this year. We still have a Fed funds rate that is 250 basis points below inflation. So if you're telling me this is the all clear sign, I'm just not agreeing with you on that. I think we still have a lot of volatility to go. I don't think the Fed is going to stop because of this one number that we see. And you and I have spoken before about the oil and the energy component that we see going for the rest of this year. Remember, there's still European European sanctions to go into place in December, along with all the other December items that you mentioned. So yes, we have a decent economy, in my opinion. You've got consumption still there. You know, I love watching the consumer, and the consumer is still strong, but I think there's still a lot of volatility, and I'm not sure that we're ready to ring the all clear bell yet.
Piece by piece then, equities up big time, the S&P 500 really rallying in the bond market, treasuries rallying big time, yields are much lower, down by 22 basis points, the dollar showing a whole lot of weakness. Victoria, as you look cross-asset this morning, right now, what do you fade, what do you go with?
So we would be fading any of those names in your equity portfolio where you're a little bit overweight. You want to trim some of those names, take some money off the table. We have been extending duration in the fixed income part of our portfolio, so hopefully you've been doing that as well. If you're an investor, and increasing some of that duration there, because we knew yields were getting close to peak. If you're going to say terminal rate is somewhere around 5%, then peak 10-year rates were going to be somewhere around 4.25, 4.30. And we've hit that. 2 years around 475, 480, we've hit that. So I think you can expect duration to start, or yields to start coming down like they did today. Maybe we go a little bit further, but I would be extending duration in fixed income, trimming on the equity side.
So I think a lot more people getting a lot more comfortable with the idea we've seen the bulk of the rate hiking cycle. I get all of that. So let's talk about the consequences. 400 basis points worth of tightening, there and thereabouts in 8 months. The consequences of that, Victoria, are we starting to see it now? And have you seen enough reaction from the C-suite that makes you say, OK, they're taking it seriously, they're resizing, readjusting, and I'm ready to buy? I'm thinking of Meta cutting 13% of the staff. I'm thinking of Snap cutting 20% of the workforce. Are you seeing enough of that to say, I think we're making the adjustment in C-suite and in corporate America?
So I think we're going to be looking, when we look at earnings for fourth quarter, we're going to be looking for a little bit more of that. Yes, we've seen valuations come down, especially for some of the defensive names relative to some of the cyclical names. So I think you can start nibbling, Jonathan, on some of these when we have pullbacks in the market. I wouldn't do it today, but when you have some pullback to go in and add to some of those names, I wouldn't go full on in tech. I wouldn't go full on in any sector at this point in time. You know, we've been very defensive, and we were adding value for the majority of the year. We're now starting to say, okay, we've seen that cash yield come down on defensives closer to the risk-free rate. So earnings expectations on cyclicals are starting now, because of things we've heard from the C-suite, are starting to stabilize. So maybe that's where you start to add a little bit in your portfolio.
Is housing part of that story, Victoria, or is it still too early?
So, you know, you talk about things having to be broken, and I think the housing market has been broken, and it's probably at the bottom. We saw mortgage applications actually go higher last week, which is a little bit surprising because the 30-year mortgage rate actually ticked a little bit higher as well. But I think maybe that could be an opportunity that you can look at. We actually added a little bit of Home Depot and a little bit of Lowe's to our portfolio over the last week and a half or so, because we do think you'll see some benefits there going forward.
I just want to ask you about the soft landing debate, because that's going to be the debate going into the weekend. Is there anything in this, Victoria, that gives you comfort, changes your mind about the trajectory for this economy?
I wouldn't say it changes my mind, Jonathan, but I would say, you know, a month ago I would have told you a soft landing was a unicorn of an idea. I don't think it's as much of a unicorn now. I still think the Fed is going to continue to push. They say they're going to look for the lag effect going through the economy, but I think they're going to continue to push because they're not going to be satisfied with a 7.7% headline CPI or a 6.3% core. They're going to keep pushing, and I think that's going to lead us into a shallow and short recession next year.
Victoria, I asked this question of Jim Bianco and Krishna Mamani maybe 20 minutes ago. Let me ask it of you. This feels like more than just repricing the December meeting, taking it down from 75 to 50, when you see moves of more than 3% in the equity market and moves of more than 20 basis points lower in the bond market. Victoria, what do you think we're pricing in here?
You've got to be cautious here, Jonathan. I just don't think Powell is ready to make a move. And you can define pivot however you want to define it, as a pause, as not, you know, hiking as quickly. But I think he's going to continue down the path that he has laid. I think we're still seeing at least 50 basis points in December and a couple of 25 basis points in the beginning of next year. I don't think we're getting a pause here yet. So I think people need to be cautious on these knee-jerk reactions in the market and acting on those.
seeing some big moves. Victoria, what a morning to catch up with you. Thank you. Victoria Fernandez there at Crossmark. Up by more than 3% on the S&P, up by more than 4% on the Nasdaq. Some of the biggest moves we've seen going back to April 2020 in the bond market. Major moves there as well. Down 20 basis points right the way through the curve from 2s out to 10s. On a 10-year, down 21 basis points to 387. On a 2-year to 434. Let's break this one down just a little bit more and get some movers off the back of this. Abby, wild moves this morning.
It is incredible, John. And to your point that this may be more than investors, traders pricing in December being a little bit softer in terms of hikes. If we take a look at the average volume on the open, more than 110% above the 20-day moving average. Right now, 40% above. That's another way of saying these dip buyers are serious. They want in. And you can see it with big tech. Apple up 4.5%. Microsoft up 4.8%. Amazon, Nvidia, both up more than 6%, the best day since July and May for many of those stocks. So as yields absolutely plunge, you have investors buying the tech weakness, buying that dip. But it extends to this area of weakness that we've had more recently, the crypto bounce. We are seeing Coinbase Global up 8.6%. Big gains right across the board. We even have Block there up 11.4%. So the question around contagion, whether or not the crypto could have some kind of influence for stocks to the downside. Well, it's interesting because if you take a look at Bitcoin here in white and the S&P 500 in blue, a very close correlation. Yesterday, it looked as though maybe that plunge in Bitcoin was going to bring the S&P 500 down. But right now, John, it actually seems to be the reverse. So stay tuned here in terms of this big risk-on move that we're seeing today.
Abby, thank you. We heard from Patrick Harker of the Philadelphia Fed. We're hearing from the Fed's Laurie Logan, of course, of the Dallas Fed, who said this just moments ago. CPI data are welcome relief, but a long way to go. The message from the Fed, the process of cooling off the economy, quote, is just getting started. This was what Victoria Fernandez was talking about just moments ago. Is the Fed going to make a pivot anytime soon? Based on that, I don't think so. Coming up on this program, crypto exchange FTX heading towards bankruptcy, putting the industry in the spotlight.
We need to have strong global standards to make sure that there are no gaps in the international regulatory framework where you can see risks like this spread.
That conversation up next.
We need to have strong global standards to make sure that there are no gaps in the international regulatory framework where you can see risks like this spread and you can have the risk of contagion or even systemic risk spreading to the broader financial system. I don't think we're at that point.
Crypto exchange FTX drawing attention from regulators after a bankruptcy warning. Bloomberg reporting the firm is facing a shortfall of up to $8 billion, needing half of that to remain solvent. The situation prompting rival Binance to scrap its takeover bid. The company writing in a statement, quote, "The issues are beyond our control or ability to help." Team coverage starts right now with Bloomberg's Shanali Basak and Katie Lights for more. Shanali, what a couple of days.
What a couple of days. And now you have Sam Bankman-Fried, the CEO of FTX, online tweeting an apology and saying that he's still in talks with investors to raise, and I say the word liquidity. He does not say capital. He's in talks to raise liquidity. He is trying to make customers whole. And he does say that FTX US, which is the US-based exchange that, operates with people in this country, was not financially impacted by what had happened. And he says that with 100% liquidity there, every user could fully withdraw should they want to. So a lot of people looking to get their money back when it comes to FTX. Sequoia, as you're going to talk about more, is just one of the investors that are facing major losses. SoftBank, other billionaires that have put in money into $2 billion worth of capital raised just last year alone. But to your point, people who put $2 billion in, somehow now there's an $8 billion hole. And how people make that hole full and pay investors back at the end of the day is very unclear and will be very costly as well. His fortune in just a day, 15 billion at least wiped out entirely. We've reported now multiple times that the SEC, the DOJ, and the CFTC are all looking at how client funds were used. Reuters, John, has reported that about $4 billion of customer funds were potentially used when it came to his other investment firm, Alameda, the trading arm here.
And Katie, that last piece of the conversation, that thought on using client money that Shanali just mentioned, that's problematic in a major, major way.
Yeah, and we'll have to see what the legal and regulatory ramifications of that are, John, because this is real people's money that we're talking about here. And they already had suffered greatly in the first crypto implosion of the year back in May when Terra USD collapsed, and we saw the ripple effects of that. I will say crypto's getting a bit of a breather today, in part helped by just risk appetite on the rise after CPI, with FTX's native token, FTT, up about 120% on the day. But it has been a bloodbath on the week for people invested in many of these tokens on the week. FTX's token is down 84%, Bitcoin and Ether down 14% and 16% respectively. And I just mentioned Terra USD, John, which of course was an algorithmic stablecoin. Another asset-backed stablecoin, Tether, is breaking its $1 peg, and that is a sign of potentially further systemic risk as well.
Looking forward to your coverage a little bit later. Special programming coming up with Shonali Basak and Kenny Lyons. I believe Matt Miller interrupting that show too a little bit later. Looking forward to it. 1 p.m. Eastern Time. Peter Cheer joins us now of Academy Securities. Pete, I want to start here. For the people who aren't in this asset class, they don't hold any of this stuff, can you explain to them what this might mean for them, the potential for contagion through traditional asset classes?
Yeah, and I think there's two elements of that. One is what it's going to do to markets. So I think there are companies that are directly tied to crypto. Some, that's their business, whether they're miners, some that's where they developed. That's going to be an important loss, and I think that's going to continue, right? People are not going to rush back into this. I'd be fading this kind of bounce in crypto. The other part is, what does this do for the economy slightly longer term? And I've been arguing for a while that this time when crypto got to 3 trillion, it was a big part of our economy. As it's shrinking, it's now below 1 trillion. You're going to see less spending on semiconductor chips, right? They were huge buyers for these mining rigs, for all the software that they needed. You're going to see less ad spending, right? We might finally be able to get through a sporting event without Matt Damon telling us to, march off to do something exciting. And finally, I think we're going to see less energy use as mining drops. So there's going to be a lot of real world repercussions from this. And that's going to take a little bit longer to play into the economy.
Pete, is that a tradable story?
Yeah, I think it is tradable. I think for myself, it is actually going to add to the deflationary pressure. I think you are going to see, again, with less semiconductor spending, less energy usage, you are going to see some of this deflation that I think we're already starting to see creep back into the picture if you ignore kind of the erroneous housing data we tend to use. So that is actually going to be good for rates, and that will allow a lot of stocks to do well. I think it's going to remain weak for housing. I think you're going to see some pressure on autos. Anything where these people involved in crypto are spending their money, it's just going to create pressure. So I think, to me, it actually really increases how deep the recession is going to be and the timing of that. So I think we're going to get a worse recession. The Fed's already gone way too far. And this crash in crypto is going to contribute to that recessionary pressure.
You've been talking about that for a while, Pete. Let's talk about this market move right now. Then I've got to move on. Yields down 24 basis points at the front end. Equities up by close to 4% on the S&P. Pete, it sounds to me, at least, that you'd push back against this move.
No, I love this current move. I think we kind of rally for a little while. I think we're going to see yields come much lower as people realize the Fed's going to have to back off a little bit. And we have to make this transition, right? We're going from recession to some of this thing's going to look like a soft landing. People are going to start talking about soft landing. We're coming into Thanksgiving. It's always seasonally well. So we're getting all this nice noise. And then I think it's going to be as the data really starts hitting that, this isn't soft landing. This is going to be hard landing. We have crushed parts of our economy. We've just taken out another leg of the economy as crypto's gone down. And that's going to be the reality. So I think we can enjoy this for a week, 2 weeks, maybe get back to 4,200 on the S&P. And then I think the reality sinks in.
Sounds like a bear market rally. Peter, thank you, as always. Peter Cheer there, breaking it down on crypto and this market move. Up 5% on the Nasdaq, on the S&P, up by 3.6% with the sector price action. Here's Abby.
John, well, these moves are simply stunning, and one way to put it, green on the screen. All 11 S&P 500 sectors right now up more than 1%. Energy, interestingly, is the worst sector, up 1.4%. Not surprisingly, mega cap tech on top. Consumer discretionary up 5.4%. Think of Amazon. Tech up 5.3%. Think Apple and some of the chip companies. Real estate, this is interesting, also up 5%. That, of course, is a sector, those stocks, high dividends. So when yields plunge like they are today, the dividends on a real estate sector or, say, the utilities look much more attractive. But the bulls are clearly buying today. And relative to some of the subsectors that are also really outperforming, technology and equipment up nearly 5%. The stocks, chips up 5.6%. And then the FANG index and China tech, it is absolutely soaring, up 6.8% on those yields down, John.
Abby, thank you. Yields down and equities absolutely flying. Up next, your trading diary. The trading diary into the weekend. We're almost there. One more trading day after this one. From New York City, this is Bloomberg. Downside surprise on inflation, sparking a major rally. Inflation comes in softer, weaker, negative, even on core. Look at this move on the S&P, up 3.9%, the biggest one-day move going back to April 2020. On the Nasdaq 100, up by more than 5 percentage points, and yields absolutely plunging. Twos right the way out to tens. On a 2-year yield, down by more than 20 basis points, with lower by almost 25. That's the price action. Here's the trading diary. President Biden speaks again at 3 Eastern. Look out for that. More Fed speak. Mester, Daily, George, all on deck today. Then we get Mitch sentiment tomorrow. Looking ahead to next week, the G20 kicking off, plus more Fed speak. You'll hear from the New York Fed President, Mr. Williams, Monday, followed by Harker and Barr on Tuesday. Bit of PPI data in the mix as well. Tons coming up. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.